Hello friends. Today we are going to take this opportunity to talk about Piper Serica Angel Fund. The idea of this conversation is to take you through what is a fund, what we do, how we identify companies, and I have Abhay today here who will give his thoughts about everything that we do at Piper Serica Angel Fund. So Abhay, first things first, I think it's good to kind of get the audience to know why we started
Yeah,
Piper Serica
yeah,
Angel Fund, and also maybe give a little bit of background of all the startup investments that you have done in the last
sure,
5-7 years.
sure. No, Ajay, thank you for that. So I think our investor base and the market generally knows us as public market investors because Piper Serica as a fund manager is a company that manages public market funds through its PMS, through its FPI and other advisory accounts. So obviously, when we launched this angel fund, we were asked that time. But I think the reason for launching this angel fund is that we want to give an opportunity to our existing HNI investors, family offices, and smaller investors also to participate in a structured manner in investing in startups. And this is a space, I think, which is a very valuable space for investors to look at over the next 5-10 years. And I have been part of early stage startup investing for last 28 years when I worked with Citibank and then JP Morgan Private Equity Fund. I mean, for instance, I was one of the team members when we gave seed capital to Jubilant Foodworks, HDFC Securities, MTR Foods. And subsequently, we have invested as Piper Serica in a proprietary portfolio in more than 50 startups now using the same methodology. And as you know, those 50 companies have done very well. Some of them are close to unicorn like Khatabok. Many companies have gone on to become multi-baggers on valuation basis. They have raised next rounds of fundings at much higher valuation. So there is a clear methodology that we have in place, and using that methodology and catering to our investor demand that, look, we want to invest in Indian startups and how do we do it in a structured manner. That is the reason that we have launched this fund, and I'm very happy to see that we have already got great response from our investors, from the ecosystem, the startup ecosystem. And I'm very happy that our objective of giving access to our investors to startup investing is gathering pace and is doing well, and we are meeting that objective.
I think from what you said, Abhay, I will pull two words out. So one is you said that you've invested in about 50 companies.
Right.
And you use the term startup ecosystem.
Yeah.
So how do you really source these deals? How
Yeah.
do you identify? How do you
Yeah.
get to a point where companies or founders are talking to you? That, okay, I want to raise funds. What is the startup ecosystem all about?
No, that's a very good question, and I'm glad you asked because, from my experience, I can tell you that the startup ecosystem in India is a very nascent ecosystem, and it is a very closed ecosystem, unlike public market investing where all investors have access at the same time to all listed companies, and then it depends on their research which companies they want to buy or sell on a daily basis when the stock markets are open. Unlike that, the startup opportunities are not easily available. You need to be part of that ecosystem that shows you the deals. Now, the other problem is that there are all kinds of deals which are available, but as a fund, we want to do the kind of deals that we want to do. We have a very well-defined set of objectives that we want to meet, or the criteria that the company should fulfill. So getting access to those deals happens only and only if you are part of that ecosystem. So it's not possible for someone to start an angel fund tomorrow and start sourcing deals because you will get access to deals but not the kind of deals you want to do. And I think that is where our biggest competitive advantage is, that we have access to deals from other platforms, other angel funds, other founders, accelerators, incubators. Over the years, we have built those relationships and they see us as amiable, value-added investors. They are asking us to come into deals. So I think we are a very advantageous position that we are seeing the deals that we want to do, and we are seeing 20 deals before we do one investment. So our deal activity is also very good. So I think that is really one of the core advantages that we have in Angel Fund, which is just access to fantastic deal flow. And then what happens is that translates into being able to do the kind of investments that we want to make. Like, that we have defined very clearly the kind of companies we want to invest in. So we will invest at a stage of the company when it is generating revenues. So if somebody comes to us and says, look, give us money, we have this great plan on the paper and it is a great product and will change the world, we will not invest. We will invest only if we see revenues. The company should have customers, because being able to diligence the customer's perspective, being able to talk to customers and get them to say that yes, this product made by the company has a tangible ROI, so I will buy more of it and it is a valuable product for me. That is very important part of our diligence. So we need a company that is generating revenues. We will invest in a company that has multiple founders. It should have, we will not invest in D2C companies, companies that make physical products, because that is a business that requires a lot of capital. So our capital will not be enough and we don't want to be diluted again and again. So we want to invest in companies that are using very strong technology, and it doesn't have to be a software, it could be medical technology, it could be anything, but using technology to create a business, to create value for the customers and for the shareholders. And the third thing is that we will be co-investors. We will not be lead investors. This is our first fund. So what we want to do is to work with very strong lead investors who are subject matter experts, benefit from their experience, and basically come in as investors who help the founders get customers, get the next round of funding done, and maybe even help in hiring, which are the three big challenges that startups have. So the long answer to your question is that we have access to the deal flow of the deals that fit into this criteria. Because unless we do that, then we will be just forced to react to all kinds of deals that come to us without any coherent plan.
But isn't it, once you're there in that ecosystem, you source deals from accelerators, incubators, other funds, other platforms, yes, other founders. Isn't it a very heavy activity? We might be getting maybe 10, 15, 20 deals a day. So how do we go about filtering? If I am getting 20 deals, how do I go about filtering? Because if I'm spending an hour also filtering each deal,
yes,
it will take me 20 hours. So how is there a secret formula to that?
Yeah, I think more than the secret formula, it is our secret employee in the company. It's a digital employee called Yoda.ai that we have created, and that is a screening tool that really saves us hundreds of man hours of work. And Yoda.ai is an AI/ML based product. It's a proprietary tool that we have created. It is a methodology learned over 20 years of application, which we have converted into a software. So what it does is, for any deal that we get, it asks you to answer 17 variables. And these variables are things like how many founders are there, what is their background, what are their core skills, what is the equity distribution between the founders. Then it has a section on the business, how big the target, the total addressable market is, what is the competitive scenario in that market. And then it also comes to the financial part, that how much of fundraising is being done, how long will that fund last. Then it looks at who are the other lead investors, what is their core competence. So like that, there are 17 variables, and anyone in the team, before taking the deal to the next level of diligence, has to answer those questions. And if the score is above 70% of probability of success, only then we take the deal to next level. So this tool does is that it makes decision making very fast. So we don't have to look at every deal that comes in, spend hours engaging with the founder and wasting everybody's time. We can make a very quick decision that, look, here our tool is telling us that it is more than 70%, only then we look at that deal. And the good thing is that, back tested over thousands of companies, Yoda.ai has worked beautifully. So it has never generated a false negative. It creates some false positive, which is fine. We cover that in bigger diligence. So to answer your question, Ajay, I think in a very disciplined manner, sticking to Yoda.ai score has saved us a lot of time and effort, and given us the liberty to focus all our energies on the few deals that filter through it with a very high probability of success. And then as a team, we focus on making sure that we close those deals.
So two questions, and I understand that the process goes this way: that there is a lead investor,
Yeah.
which is the first filter, and then there is Yoda AI, which is a second filter, and then you said there is a greater diligence that is done.
Yes.
Now, if not two, maybe three questions. How big is the team that does diligence?
Yeah.
What is the kind of diligence that we do? And lastly, what is the intensity of deals? I mean, how
Yeah.
many deals in a month, in a quarter, or a year? I mean, is there a target of sorts for that?
Yeah. So, so in the fund, I'll answer the last question first, so that because it will help me answer the other two questions. So, as a fund, we are a 100 crore fund. That's what we are targeting to be, because this is our first fund. We don't want to go beyond 100 crores. And with that 100 crores, we want to make 30 to 40 investments over the next couple of years. So that is our deal pace. So now if I say 40 investments over 2.5 years, 30 months, that means we are closing about 1.5 or 3 investments per 2 months. That's our deal pace. And I think we are well on track. We have already done 3 investments, 3 more should close soon. And maybe by the time this video is out, we would have larger, number of deals already done. So that is the deal pace. Now, in terms of our diligence process, I would break the diligence process for the fund into 2 parts. One is before our commitment, before we commit to the company, or let's say before we make a hard commitment to the company. So we engage with the company. So the process is, first we get a high Yoda.ai score, and then we say, okay, we want more information. Then we have a checklist that we share with the company to ask them for information, and that includes things like what is the last 12-month MIS, what is your cap table, and who are your customers. And we see the product, typically there's a product, we do a product demo, we talk to the CTO. So as part of our diligence, we spend a lot of time on 2 things. One, engaging with the customers of the company, because we want to understand from them what value they see in the product and what is the level of development of the product. And the second thing we spend time with the employees, key employees of the company, the CTO, the sales guys, the product guys, CEO, CFO, to understand from them how do they see the company, and what is their perspective of the future. And the idea is to make sure that the entire company is pushing in one direction. We don't want a situation where there is no clarity of a target and different people are moving in different parts. Because only when there is clarity, there is efficient capital allocation. So that is the second part of our diligence, which is meeting the customers, meeting the employees, talking with our co-investors to understand from them what is their deal thesis and is it in sync with ours. So that, I would say, is our pre-hard commitment diligence, and that is where we spend a lot of time. And I think we benefit also from the fact that we do this as public market investors. I mean, as you know, whenever we are doing diligence in any company we are looking to invest in, we use Michael Porter's model to do full 360-degree research. We meet the customers, suppliers, retailers, distributors, bankers, employees, ex-employees, competitors. So it's the same diligence, rigorous diligence that we try to bring to this startup investing also, but with the caveat that data points here are much lesser than a listed company. So we understand that, but still we try to do as thorough a job as possible. And then comes the last level of diligence, which is post hard commitment. That then I want to check that the company doesn't have any legal issues, GST issues, TDS has been paid on time, contracts, any contractual liabilities. And that is where we outsource it as a group of investors to a specialized accounting and legal firm. And that legal firm does detailed diligence, generates a report. We go through that report, any outstanding points which can be covered become conditions precedent to the closing. And if some of those points in a situation that cannot be resolved, then obviously we will not go ahead with the investment. So it doesn't matter to us how much time, effort we have invested. If there are sticky points which we are not comfortable with, we will just not go ahead with that investment. So this is how our diligence process goes, internally and with external help.
I stay on this because I am sure the audience will have this question. 2 things. One, as you rightly said, right? Public market, you have a whole lot more information. Whereas in private investment, and that too in an early stage investment, the data points are few and far between.
Yes.
So how do you manage that? That's question 1. Second, since we are investing in maybe 35, 40 companies in different
Yes.
sectors,
Yeah.
in different kind of business models. Now, while we will be able to understand briefly every business model, maybe get our arms around how the entire business functions,
Yeah.
what are the strengths, what are the modes of that business, whether there are some, whether there are not. But then there is a whole issue of subject matter expertise. I mean,
Yeah.
let's take an example of a tech company who will, they throw terminologies at me like, I have this SDK, I have an open API,
Yes.
closed API
Yeah.
लगा देंगे, and
Yeah.
etc. etc. So when you are doing diligence, when the team is doing diligence, how do you capture that subject matter expertise
Yeah.
in your
Yeah.
work?
So again, good questions. The second question, taking that first, is that obviously when we are investing as tech investors, we need to understand tech, but the reality is we will not understand the core tech. We will understand what is the use of that tech. What is the business use or business case, use case we will understand. But at the same time, to make sure that the product is actually what it is, we typically bring in external help, and we are very fortunate that we have an external board of advisors which has very senior domain experts. So like we have one board of advisor member who's an expert in crypto technologies, so not only just coins but the entire blockchain technology. So we refer to him any deals where we need help with blockchain. Then we have somebody on the medical side. We have someone on the software side with very deep access, 2 decades of software development experience. So what we do is we bring in this external help where we bring in subject matter experts to have their view. Like one of the deals we are just looking at, which is into workflow automation, and then we have Shamik Gupta, who's our one of the advisors, and he is a founder of a company that does workflow automation. So once he looks at it, we get a far better idea. So we are very open to taking help from anyone in our network to make sure that we are understanding it correctly. And on your second question, Ajay, actually I would like you to cover that, which is a very good question. That doing public market research, we have learned a lot, and then how does that research framework translate into our private market investing or startup investing? Frankly, I would like to know from you that how do you look at it, because you get involved in it at a far greater depth, with a small team.
I think, Abhay, for me, I have a checklist on paper also, and as well as in my mind. And public market is a very large ecosystem where companies are already mature. They've already got to a point where they are profitable. They have a large national level brand presence, distribution, sales. Everything is well set. Whereas in private investment, and that too at a stage that we are coming in, I don't think the business is that well set.
Yes.
So if we get lost in trying to figure out, okay, whether this business is perfectly set and it will grow in its current form, I think that's a wrong start. So for me, the way I look at it, I first try to get my arms around the entire business model. What is the operational challenges, whether there is a sales ecosystem in place, because having done whatever we've done so far, one thing that I very clearly know how to evaluate is whether this company, whether these guys have a sales
Yes, absolutely.
presence. Do they know how to sell?
Yes.
Because selling requires processes around itself. So do they have that sales distribution process around themselves already? So that's one thing that I spend time figuring out. The other thing is to understand, since we have public market construct, we can bring in expertise from them. Whether, for example, if it's a healthcare company, we can loop in someone like Apollo Hospital,
yes.
because we've had investment in that company for about 5-6 years. I know them personally for a fairly long time. So getting expertise like that to evaluate the brass tacks of the business model. But I think a lot of weightage is given to two things. One is the founder credibility.
Yes,
How many
absolutely.
founders do they have the depth of the product or the business ecosystem, and at the same time, what is their current cap table like? So who are their investors? Because it's these investors who will help them get to the next round. It's these investors whose expertise they will count on to create a culture inside a company, create systems, create processes. So I think more than business level data points, it's these data points that I run my checklist through. With the caveat that I also tend to spend a lot of time trying to talk to customers and
Yeah.
take their
Yeah.
feedback
Yeah.
as to what has been their expertise, their journey, and how quickly or if at all will they switch from a product like this. So I think that's what I spend my critical time analyzing. But since we're talking about this, Abhay, what's the plan? As in, how many investments does a fund plan to do over the next 2-3 years?
So as I said, we are looking at total around 30 to 40 investments, and I think that from kind of deal flow that we are seeing, we should be able to get to that pretty easily. The challenge always is that at times you do not get the kind of companies that you want to invest in, or you look at a company in great detail and spend a lot of time, and then finally you find something which stops you from going ahead. So there are those situations, there are drop-offs, but so far our experience in last 4 or 5 months, I would say, is very good in terms of, and you have seen it, and the rest of the team has seen it, that we are seeing some excellent deal flow. We are working with probably 15-20 other angel funds who are bringing us in their deals. We are working with a lot of platforms. So I think 30 to 40 deals, and which will help us reduce the mortality rate, because the biggest risk of investing in an angel fund or a startup fund is that, unlike a public market fund, there is illiquidity, and at the same time there is high mortality rate. Not all companies will succeed, definitely not all companies will succeed. Now, using Yoda.ai earlier from our prior portfolio of 50 companies, we have kept the mortality rate very low. So hopefully that will be the case here also. But at the same time, to make sure that we are not over dependent or we are not over allocated to 1, 2, 3 companies, what we want to do is to build a portfolio of 30 to 40 companies, and whichever are doing well, we want to stay invested in them as they go through their next rounds and growth.
Interesting, because that brings me to a point that I was waiting to ask you. So you said risk,
Yes.
you said mortality. Now, one of the biggest fears that most investors in startup ecosystem have is, look, I may lose all of my
Yes.
capital.
Yeah.
Now, what are we trying to do to reduce the risk?
Yeah.
What is our risk management framework? Maybe in terms of allocation, maybe in terms of diversification. And since you've been a fund manager most of your life, you will understand risk management far better than anyone else. So what is your thought around that?
No, I think risk management is a core part of the job for any fund manager. You can't be a good fund manager unless you are a good risk manager. And what that means is that whenever we are looking at any investing opportunity, we do not look at it in isolation. We have to look at it because the investor is investing in a fund, they're not investing in a particular company. So what we want to make sure is that the business risk or the mortality risk of the entire portfolio is as low as possible. So what we are doing, Ajay, to mitigate our portfolio risk or mortality risk at a portfolio level is that, first of all, we are diversifying our investment. So we are not overtly focused on 1, 2, or 5 companies. So we are saying continuously that 30 to 40 companies is what we will invest in. So any investor who comes in, whether whatever the amount they invest, that amount will be broken up pro rata into across these companies. Secondly, what we are doing is we are co-investing with other funds. So typically, if there is a round size, whatever is the round size, our share in that round size will not be more than 25 to 30%, because we want other investors to also come in, do the diligence, be with us, and so we will be co-investors. We will not be the only investors. So as a result, the promoter always not only has help from multiple investors, but also knows that they have to maintain the best practice in terms of corporate governance and any other, because there are so many investors involved. So these are the 2 things we do. And the third thing obviously is that we do not want to invest in companies that will run out of money very fast, because high mortality rate comes in when you give money to a company that is not adequately capitalized. It uses up all the money, and then 3 to 6 months later has 2 options, which is to raise money, and if they're not able to raise money, to shut the company down. So we are giving money to companies which are already revenue generating. As I said earlier, the reason that we want to give money to companies that are already generating cash flow is that they can support some of their capital requirement from their internal cash flow generation. They're not really dependent on external capital all the time to fund them. And that is why D2C companies we are staying away from, because they need a lot of capital, whereas pure services companies, software companies, technology oriented companies can reduce their burn rate and get to profitability much faster than a D2C companies. So making sure that the companies that we are investing in have a clear path to profitability, at least at the cash flow level, that is very important, and that is one of the things that we want the founders to be disciplined about. We want the founders to be anxious to get to that profitability level, cash break even level as soon as possible, and then from there on whatever capital they raise is to purely for growth purpose. So that is, I think, doing these three things sensibly is the way that we reduce the mortality risk for the entire portfolio.
Understood. So, while you've talked a lot about the entire journey of investing, one thing that constantly people ask about, and I would say a lot that the entire ecosystem also is not sure about, is exits.
Yes.
So,
Yeah.
and I'm sure every investor watching
Yeah.
this will want
Yeah.
to understand ki, okay, I know how you identify companies, but show me the money.
Yeah.
So how do you, I mean, one is to just from a theoretical perspective explain
Yeah.
to the audience in what scenarios does one exit,
Yeah.
what are the kind of realizations in these exits, and how is Piper Serica Angel Fund kind of
Yeah.
looking at exits, cash flow, liquidity?
Yeah. I think this is something again we have discussed in detail, Ajay, as a team, that whenever we are making an investment, we have to have a clear sight of an exit plan. You may not know when and how, but there has to be some concurrence. And we have discussed it, Ajay, also as a team, and maybe it is a good idea for you to talk about when you are looking at companies. You talked about diligence, how you talk to the customers, how do you. So I am also curious to know that, when you're talking to the customers, do you have in your mind calibrating some way with an exit plan that, look, if the customers are happy means it will lead me to an exit. So how does your research calibrate into an exit? Because at the end of the day, we have a fixed term life, fixed fund life, we cannot own an investment forever. So we come in at a value and then we want to exit at a much higher value, and we want to be able to exit. So I'll flip the question to you to ask you that when you're doing your research into these companies, how do you make sure that your research is also has the exit angle to it?
So I think theoretically, exit happens in three ways. One is, of course, everyone knows an IPO.
Yeah,
I mean,
sure.
That's an ultimate gratification. But
Sure.
apart from that, exit happens either when a company is bought out by a strategic buyer,
Yeah.
or by a strategic investor.
Right.
And the third one is, of course, when companies do larger rounds. So when I do my diligence, when I look at a company, what I try to understand is what is going to be the exit journey for this particular deal. For example, the first deal that we did in the EV company,
Yes.
maybe there will be a strategic buyer, but
Yeah.
more than a strategic buyer, I think the company will evolve into maybe a few $100 million valuation company over the next few years, because the business model is such that they will constantly keep raising, if not large, but smaller amounts of capital at a very frequent interval. So I think there, to my mind, to my understanding, and while I was doing my diligence, the exit path, according to me, is that the company will do maybe a large series B,
Yes.
C, D
Yeah.
somewhere in the next 3-4 years, and that's when we should be able to see an exit event. I think the second one, Credit Watch that we did, I think there, and the founders also were in coherence with this fact that, look, tomorrow if there is a strategic buyer who's interested in buying this product or this company, we will sell. So to my mind, yes, when I am doing my diligence, I try to figure out whether this company will get to IPO in the next 7-8 years, whether it's a strategic buyer that will buy this company, or whether I will get an exit through follow-on fundraising. But is there something that I missed? Maybe is there something that you can add to this?
No, I agree. I think that is, I mean, second, for angel funds like us, I think the, as you rightly said, the two outcomes that I can think of as an exit is, one is a buyout by a larger fund who comes in B or C round and says, look, the cap table is too big and these are angel funds and they have, been around, they have made money. So I'll make them an offer and, I'll buy their shares and I'll put some company. So if it's a $10 million round, I'll put 8 in the company directly and 2 I'll use to buy out these guys. And maybe that is at a slight discount, but that's okay. You're a secondary investor. So that is one good outcome. And the second outcome is that the founder also exits the company along with you, and there is a strategic buyer who says, okay, I want control. So the founder is willing to sell, and as part of that, you also sell. And I think that is those are the two good ways. IPOs take time. From the time we invest, I think IPOs would be at least 12 to 13 years, far away. So maybe that is not envisaged by us right now as an exit mode. But let me ask you, so this is what we are expecting as an outcome. But how do we document this, as a right? Because when we are doing our documentation, what is our agreement with the founder, to make sure that our rights as a shareholder are also protected, because once the founder has taken money, how do we make sure that the founder is sticking to what they agreed with us?
So our investing documents are very legally tight that way.
Okay.
So there are so many rights that we can talk about, drag along, tag along. But I think since we're talking about exit, every deal that we do, every document that we sign, we make sure that there is an exit clause, that the company will give us an exit or try very hard to give us an exit in the next 5 years. Maybe in some case 7 years, but 5 years is a standard. To add to this, I think a tag along or a drag along right also works for us, because if the founder is planning to exit partially or fully, our shareholding goes out first.
Right.
So that way, I think the exits are very well covered in the documents.
Yeah.
But so when we talk about this, and since you've done this far more than just at Piper Serica, typically if it's a 10-year fund, what according to you is the cash flow journey? Because we'll be deploying capital in the next 2-3 years. When do we first start seeing liquidity? And while it's a 10-year fund, does that mean that I will see all my money in 10 years or at the end of 10th year? Or I'm just trying to understand what is the cash flow journey for an investor.
No, I'm glad you asked that, because I think there is some misconception that investors get in their mind when they hear a 10-year fund. So unlike a mutual fund that takes all the money at one time and then gives the money at one time, here what we try, while we say it's a 10-year fund, it's not that your money is out for 10 years from day one. What happens is that, as we said, the money will be drawn over 2.5 years. So the way we have structured the drawdown is 40% on commitment or signing of the agreement, contribution agreement by the investor. Another 40% after 1.5 years, depending on our deal pace. And balance 20% after 2 years, 2.5 years, again depending on the deal pace. So the money is going over 2.5 years. It's not going immediately. Then the deals that we have making earlier, hopefully we will start seeing exits over 5 years. So maybe the deal that we're doing now, we will start getting exits over 5 years, 6 years. And our endeavor here will be to try to return at least the capital back to the investor, whatever they have committed or invested, within 5 years. So that capital is back, and then after that, whatever is there becomes pure profit. Now, why we have said 10 years is the fund life? It's not that we are going to hold for 10 years, because the way the fund is structured, every time there is an exit in any of the companies, we give money back to the investor. We can't hold it. So anytime there is any investment that is sold or liquidated by the fund, the money goes back to the investors. So the way the cash flows will work is you will pay for 2.5 years, and then by 5th year or before, you will start seeing money back, and hopefully whatever you have invested in 2.5 years will come back to you within 5 years. And then the investments made in the 2nd, 3rd year will pay you in 6th year, 7th year, 8th year. And the reason for keeping it 10 years is that if there are some exceptional companies that we don't really want to exit because we see tremendous value in them, we have the ability to hold it for 10 years, but it's not that we will definitely hold it for 10 years. So I think that is how the cash flow of the fund should be understood by the investors. On an average, you can say, if I was to say what is the average holding period for my entire fund, I would say 5 to 6 years, not more than that.
Abhay, you said that, you use the term mutual funds,
Yeah.
right? Mutual funds work in a very different way compared to private investments. And in public market, if we have a portfolio of, let's
Yes.
say, 25 companies,
Yeah.
And let's say a fund having a track record of 15 to 18% CAGR, typically returns would have come from maybe 15, 16 companies. There would be some companies who would have contributed negatively, and then some which wouldn't have moved.
Yeah.
That's the return distribution in public market. But how is the return distribution in early stage investing or typically in private investments? Is it similar to public markets, or is it more skewed towards, because I keep hearing a lot about the 80-20 principle also.
Yes.
So if you can talk to the audience about the return distribution in terms of out of 35 companies, how will the return be split?
Yeah, I think from experience we can, and there is a lot of studies that have been done in the US especially, which is a very mature early stage investing market. You have tons of funds, you have HNIs, angel funds, who have made this into a very professional enterprise early stage investing. Legendary funds like Y Combinator and the likes. So whatever data we have seen so far, and I think that is also I've seen this across multiple funds, is that if you have invested in 30 companies, you would expect 7 or 8 to fail completely, and by fail I mean not being able to return capital back. Then you would have about 10, 12 that will give you 3x, 4x your money back, and then there are 5 or 6 that are 10 baggers, so they significantly impact your fund return. But then it is those 2 or 3 outliers which make you 100x your money, 100x, more than 100x, and there are enough examples. You see, forget about the post listing situation, but still even at the current price, companies like Nykaa, Paytm, Zomato, they have created 800x return for their early stage investors even at this price. So those are the kind of companies that pull up the total funds return upwards, so that you can target a 10x return on the portfolio basis. That is how the typical distribution is. Now, what we are doing, we are trying to keep the mortality rate high, to keep the number of failures low, so that our fund actually outperforms the other funds.
Interesting. So I think that was a lot of information, but before we wrap, I would like to ask this typical question that I am sure every investor watching this will have. कि मेरे को कितना मिलेगा? So what is the return expectation that an investor should keep in mind when they are investing in Piper Serica Angel Fund?
No, I think you, Ajay, talk a lot to investors and distributors. And we have discussed this, that what is it that we are tracking, why we have launched this, because our distributors ask us, right, that look, if I just put money in a mutual fund, and the mutual funds have given over 10 years, let's say 16% IRR, and on an average, and they are liquid, so I can sell anytime. So here, this is illiquid. You get liquidity only when an underlying portfolio company is sold. So it's not liquidity on demand. So for that illiquidity, how much of premium can I expect? Because at the end of the day, if you're taking higher risk and illiquid, you deserve a premium. So what do you think, is a correct guidance to an investor? A guidance that, look, this is what we are attempting to do, as a fund.
So from my mind, and let me put a little bit of theory also to this. As you rightly said, a 10-year mutual fund public market return is roughly about 16%, which is 8% risk-free rate and 100% risk premium about that. So which makes it 16, 8 plus 8. I think I would say that add another 8% for illiquidity here, which would mean a simple IRR of about 24%. But I'm sure that will confuse the investors because they will ask IRR kya hota hai? So in simple terms, when I talk to investors, and since we look at I spend a lot of time on the deal side also. When I talk to investors and partners, what I tell them is that look, you can safely assume that on a conservative basis, it will be a 7 to 10x kind of return post expenses. In terms of IRR, I would say that conservatively you should expect a 25% kind of post expense, post tax IRR. But while I say this, I think because in my conversation, I spend a lot of time answering this question, ki what is the worst case return, which I think is maybe closer to an FD return of 6-7% IRR. I don't think there is, I did this research of about 700 funds in the US, and there was only one fund which could not return the principal. So probability of principal loss is far and few between, but and I get this question again a lot of times, that what is the worst case return. But at the same time, I would like to harp on this fact that look, while you're looking at a worst case return, it is very important to look at a best case return also, because if you're a public market investor, I think a public market investor best case IRR that I would expect is not more than 20% over a 10-year period.
Yeah, that is also if the markets do phenomenally well and everything.
Yeah, I mean that is with a caveat that I invest when markets are.
Yeah, when you come in at absolutely the best time and you exit at absolutely the best time.
Correct. So otherwise the expectation is about 16-17%, but let's put it this way, that okay, the best case IRR will be 20% if I am kind of averaging it out in the first 3 years in SIPs or whatever. Now, I think the best case return in startups could be anywhere between 30, 35, 40%.
Absolutely.
And I think that again still is not the best case return. The best case returns can be much higher. I mean, I talk about this one example of an investor by the name Ashish Gupta, who invested 10 lakh rupees in Flipkart in 2008. And when Flipkart was bought out by Walmart, that 10 lakh became 150 crores. So that's almost.
So you can't make that kind of money in public markets. I
mean, making a 1500x return in public markets is impossible. I mean, not even closer to, but completely impossible. But making a 100x return or a 200x return in early stage investing is possible. And I think it's even so because I mean, even if I'm a public market investor, and I will tell you this, that look, public market investors expect a 12 to 14% IRR in a large cap fund, a 14 to 16% IRR in a mid cap fund, an 16 to 18, 19% IRR in a small cap fund, but with a caveat that in a small cap fund, minimum holding period is 7 to 8 years. Now, the reason that the minimum holding period is 7 to 8 years and the return expectation is 16 to 19% is because those companies are smaller and the ability for them to grow 10x is far more. Similarly, if I have to go one step before a small cap, which is what we are doing, I think the return expectation should be that much higher.
No, you're absolutely right, because if you look at the companies we are investing in, look at their pre-money valuation is anywhere from 50 crores, some case below 50 crores to 100 crores. So you are coming in at a valuation where it is much easier for the companies to become 10 baggers, 20 baggers, 30 baggers, because if you're investing at a pre-money valuation of 50 crores, that 50 can become 500 and can become 1500, 2000 crore. Much easier than a company which is in public market at 5,000 crore for them to become 2 lakh crore market cap company to give you 20x return in a very competitive industry is very difficult. So I think that is why the return expectation from early stage investing, when done rightly, can be much higher. It's just the kind of entry level valuation you come in at. And I think also in terms of exits with this BSE and NSE small cap, small board listings, that has given another good exit route to early stage companies with success, profitability, to list on these boards and give exit to their investors. And the last thing I would like to say is that in terms of return generation, our fee structure is completely aligned with performance, because as we keep saying, for the manager, which is Piper Serica, the fees is generated really from the performance fees that we charge. So only when the performance fees is material do we get something out of this activity. So our interest as manager is completely aligned with making high returns for the investors, because only then we get something. Otherwise, it's just a investment of time and effort for us without any outcome. So yeah, I think that is where it kind of relates. But let me ask you one more thing, that for investor, what is the right investor profile for this kind of startup investing? Because this is a unique product, not very well known in India. People have seen things like Shark Tank US, Shark Tank India. So they have seen a lot of success stories of unicorns, 150 unicorns. Media is covering it, but it has its own unique risk and return profile. So what do you think, what kind of investor should invest in this, and how much of their capital should they allocate to this?
So I think mathematically for me that's a very simple answer, that looking at the risk profile of an investment like this plus the illiquidity risk, I think this should be anywhere between 10 to 15% of an investor's overall equity allocation.
Yeah, okay.
Which means that for investing 25 lakh rupees in Piper Serica Angel Fund, their overall equity allocation should be roughly between 1.4 to 2 crores kind of.
Okay.
I think that's a right profile in terms of risk and liquidity. And then maybe because the 25 lakh rupees will be spread out over 2 to 3 years, then even if you have a equity allocation of 1.2 crores today, and you envisage that to become 1.5 over the next 3 years, then even with a 1.2 crore kind of an allocation, this is a product that will fit. But anything below that, I think there is a little bit of extra risk that the investor is taking. But at the same time, Abhay, the space that we are in, the time that we are in, I think it's a great opportunity for
absolutely.
an investor.
Yeah.
And while we're talking about this, and on an ending note, let me ask you this question, and at the same time, I will share my thought also.
Sure.
We constantly get this question, what about the funding winter, right? That a lot of startups are not getting money, not getting funded, investors are not having the liquidity, and then the whole global recession and interest rate hikes and etc.
Right.
Place.
Absolutely.
How does that impact startups?
Yeah.
Do you think that is that kind of a problem right now? How do you look at it? Because I am looking at it as an advantage that look, a lot of good companies who would have otherwise fetched a valuation of, let's say, 200 crores, we are getting those same companies at maybe 50-60 crores because they are not getting money at 200, but they will get money at 100 or less.
Absolutely.
So I think for me, when I get this question about funding winter, I am very happy to say that, look, it is working as an advantage. Because you're coming in at a time where valuations are low, where liquidity in the system is low, and where investor today has seen that last 5-7 year journey and is talking very critically about profitability.
Absolutely.
Of every startup.
Absolutely.
What are your closing thoughts about this?
No, I concur with you. I think the funding winter has basically set in because there was a lot of froth in the market, and if you look at it, even now there is no funding winter from the seasoned funds. You look at the big name branded, those guys have the money, they are investing. It's the short term guys who got in, became investors, were very loose with valuation, wanted to do a lot of deals, put out a lot of money without much discipline. They are the ones who are out of the system. But the good companies are still getting money. So it's not that funding winter has set in for everybody. I think the market has segregated the good from the bad very well. So anyways, we never interested in looking at the companies that have very inefficient business models and now have run out of money and not able to raise money. I mean, that is the nature of the market, and anyways, we are not looking at those kind of companies. But as you said, there is a spillover effect of two kinds. One, the valuations are not only reasonable, I would say they are very juicy at this point of time, because we are actually closing deals right now at same valuation that the companies got 1.5 years ago. And the reason for that is there is even in good companies, the founders are of the view that look, if I'm burning, I should at least have money right now that should last me till the time I become profitable. So even if it is small money, let me take it. I should not waste too much time. I should not shop around the term sheet. I should not try to maximize valuation. So in the bull market that we saw earlier, there was this tendency to get the best valuation. That was the benchmark, that how successful you are depends on who gives you the highest valuation. But now people have realized that, look, it's not an exit event. So I should have a sensible valuation. I should be able to raise money from those investors who can help me build my business, get it to profitability. And secondly, what is happening is that whole high burn model has gone out of the window. So we are seeing that before we tell founders, they tell us that, look, I want to turn profitable as fast as possible, and that is music to our ears. So I think we are benefiting from this funding winter in both ways. One, lower valuations, sensible valuations, and two, very sensible founder behavior. And I hope that continues. But again, I think this window is there for next 6 months to 9 months before the good old times come back, and with successful exits, you have other new players coming in. That will happen. That's the nature of the market. But while we are where we are, I think we should make the best of it. It's a great opportunity that has presented itself.
Good. So I think we can wrap up with that. But do you want to leave the audience with any closing note? I mean, do you want to share anything from your personal experience?
No, I think I hope this whole interaction was of use to you. I would like to say that the endeavor with Piper Serica Angel Fund is to give investors a very structured format that they never had. I mean, I can't think of any other fund like ours which is there in the market trying to do investments in a very structured manner like we are doing. So I think it's a great opportunity for investors to come in, benefit from the whole very high value creation by startups in this space. We are seeing some excellent founders who are foregoing jobs, who are making the sacrifices to build companies, build something that they believe in, capture the upside rather than taking up jobs. We are seeing them getting funded by very good investors. We are seeing them being able to hire very good employees with the promise of stock options and value creation. So I think we are in a very, I think next 5 to 10 years in India will be like a golden period for startups. And as equity investors or as savvy investors, you should definitely make sure that you have enough allocation to these startups through a professional fund manager rather than trying to do it yourselves. Because if you try to do yourselves, it will be very difficult to get access to the right kind of deals, very difficult to do due diligence, very difficult to engage with the founders, get an exit, which is something that, and this is all as a fund we are able to do. So I would strongly recommend that don't let go of this opportunity, give it a very serious thought and allocate funds to the startup fund so that over next 5-10 years, not only you see financial return, but you can also feel the pride that the companies that you have invested in or the fund has invested in is covered by the media, the founders are there in the media, and you can take pride in that you backed or you played a role in the success of these companies. So I think those are my closing thoughts, and we would all be available for any further interactions, conversations, anything that we have missed that you would like to know. Please reach out to our team here and we will be happy to answer your questions. Thank you.
Thank you.